just going to start off with the latest news here. President Trump has signed this Hong Kong Human Rights and Democracy Bill into law. What's your initial reaction to this? Could Hong Kong's special trading status be at risk now?
Of course, this is not a welcome news. But as you can see, the market reaction so far has been pretty calm, so to speak, because a lot of bankers and market practitioners that I have talked to, they feel that the immediate impact of the bill is not going to be huge for the time being. Much would depend on further development. So basically, what they are doing is still looking very much at the fundamentals of Hong Kong, including what we can have under the one country, two system, our independent judiciary, our common law system.
If in fact it lost its special trading status, would that be the end of Hong Kong?
No, I don't think it's very helpful to speculate on different possibility. Basically, I think the Hong Kong's special status under the one country, two system, the basic law is still intact. And that's what makes Hong Kong a place well positioned to offer the opportunities that many international investors would like to have, especially for access to the Chinese market.
Have you seen a visible outflow of capital, and do you foresee any pickup here if these protests drag on further?
Now, so far as outflow is concerned, in the past few months, Hong Kong has probably the most transparent system of the world because we operate the currency bond system. If we have any outflow from the Hong Kong dollar, we announce it almost on a real-time basis, and you can see it on your Bloomberg terminal. So we haven't seen any outflow from the Hong Kong dollar since April this year. So the kind of unrest started from June, so there's no outflow from Hong Kong dollar in the past few months. And if you also look at other metrics, say for example Hong Kong dollar deposit, it's actually pretty stable in the past few months.
But the economy has entered into a recession. We see a triple threat from a global slowdown, you have this trade war, and now the domestic situation as well. Is this time any different, do you think? Because you mentioned the markets are showing some signs of stress, but it's nowhere near anything extreme. What would then break the foundation?
Now, if you talk about the economy, you look at the real sector, obviously if you look at the GDP figure, we are going through some difficult periods. Actually, that didn't start from the middle of this year, didn't start from the summer this year. It started from actually more or less mid last year when the trade war rhetorics actually heated up. And then we saw a continued slowing of the economy, not just for Hong Kong, but regionally we see similar trends as well. Because Hong Kong is a very externally oriented economy, and our sort of intermediation role between Hong Kong, between China and US is strong. So this is having an impact on our economy as a whole. And starting from summer, we are seeing more impact on some more visible sector, in particular the tourism sector. We are seeing fewer tourist arrival, hotels are sort of having lower occupancy rate. Now, this is something that we need to be concerned about. That's why the government and the HKMA have been sort of launching various measures to help the economy, including the SMEs. We have a platform to discuss with banks as to how to help the SME. The government has launched a new loan scheme, a guarantee scheme. We had previously an 80% government guarantee scheme to facilitate bank lending to SMEs. Now the government is going to LegCo tomorrow to get funding to up it to 90% guarantee. We also have other measures, including special measures for those who were on the 80% scheme to have a principal repayment holiday. So they are only going to pay interest for 6 months, and which is extensible, so that to help with their cash flow. These are the things that we believe would really help the economy.
How would it affect the banks then? Do you see that actually hurting their asset quality?
Not really, because in terms of the asset quality of bank, as you know, Hong Kong banking sector has been very strong. The capital ratio is 20%, which is much higher than the statutory minimum. In terms of loan quality, so far the classified loan ratio is only 0.56%. Now, this is very low by historical standard in Hong Kong, as well as in comparison with other places.
Would a weaker economy force you to tweak your peg, and how are you kind of viewing this situation right now?
No, absolutely not. If you remember, the peg was introduced 36 years ago. In this 36-year period, we went through a lot of different cycles. We went through the Asian financial crisis. We went through the global financial crisis. We also went through the SARS period, where Hong Kong went through deflation for some 6 years. So the peg has proven that it will survive. The benefit is clearly visible, and this confidence in the link exchange rate is very strong among Hong Kong residents and also international investors. We see no need to change it.